Hey, this is Ken Finnan at Capital Advantage Tutoring, and it's my job to get you past the SIE exam and the Series 7, plus all the Series 63, 65, 66 exams. Okay, so all of you who dropped off already because this is just boring, let's talk about inverted yield curves and regular yield curves. In general, a yield curve is basically the difference between short-term yields and long-term yields, the difference. And the normal curve, think about it. If I borrow money for a short time, I have to pay you a little bit of money. But if I borrow for a long time, there's more risk. I should have to pay you a bigger interest rate or more return for your money to compensate for the long term. So if we try to look at this, this is the yields over here. The yields are up and down, 1%, 2%, 3%. And then we have the years. You can't see behind my fat fuck, but we're going to deal with it. Okay. So now the shorter yields you see over here, the shorter yields are 1 month. It's like, like a very low rate. And then as I have to remember, I'm doing reverse. As we go along, let's switch hands. As we get longer and longer, the rates go up. Now, this is from 7 years ago. So the rates aren't accurate. They're up to 3%. But this is a normal yield curve that the longer we borrow, the higher the rate. Now we look at the inverted yield curve, and I'll show you what's behind me. So if you look down here, it's still short. The short-term yields are still lower than the higher yields. But if you go on here, you look up top, okay? Look up here, right? We're talking up here. You see that the 5-year is at 3.25 and the 10-year is at 3.2. That's just fucked up. That's an inverted yield curve. Okay. So the 5-year is higher than this 10-year. And then look, the 20-year is higher than the 30-year. That's not normal. That's an inverted curve. That means the Fed has been raising rates and should happen. It's usually a sign of a recession. Okay, I can't think of words because I'm just an idiot. So an inverted yield curve is when the short-term yields are higher than the long-term yields in some things. It's never like I'm going to show you a video of how it works, like I do it on a Zoom, but it's never exact as that. I'm just going to show you what happens. It's always little things. It's little points inside of it. Like the beginning, the shorter things under 2 years, it's normal. It goes up. And then it starts flattening out between 3, 5, 7, 10, and 20. It bumps up for one and then it drops again. So those are yield curves. This is June. Now, what's interesting, see if I can do this. Okay, so now that I got my ugly ass out of the way of this chart, we can look at it a little better. So we have a normal yield curve, right? Which is normal stuff, normal yield curve going, working its way up. And then right here, it starts to flatten a little bit. And so the 5-year is higher than the 10-year. Okay, so and then the 7-year is higher than the 10. That's inverted. The rest of it's normal. And then look, the 20-year is higher than the 30-year. So we have a problem. That's an inverted curve. Not a big deal. But now the real predictor, the predictor of the last like 8 recessions is when the 2-year is higher than the 10-year. Now, right now, this is end of June 2022. It's not. It's close, but it's not. But then in end of July, August, boom, the 2-year's at 3.2 and the 10-year's at 2.75. That's the biggest gap. Now, as of the beginning of July, the 2-year was higher than the 10-year, but this is the largest gap that has ever happened since 2000. Okay. And that was a recession. So it almost always predicts a recession. Again, it's not a cause of recession. It's just a predictor. It doesn't mean it will happen, but it hasn't been wrong in the last 8 recessions. So this 2-year, so if you borrow money for 2 years, you're going to get 3.2%. But if you do it for 10, you're only going to get 2.75. That's an inverted. You're getting less for the long term than the short term. And again, that's usually a sign of the Fed raising rates. But let's go into how that happens. But before I do that, let's actually show the numbers so you can see them. Okay, so these are the actual numbers as of, I think, August 2nd, August 8th, August 2nd, 8th, whatever the hell it is, 2022. If you look, the short-term one, the 3-month, yeah, it's fucking low, right? But look, the 1-year is higher than the 2-year, which is higher than the 5 and the 10. That is a true inverted curve where all the short-term yields from a year or higher are higher than all the longer ones. Now let's talk about why. We can do the chart. Okay, so this is what a normal yield curve looks like. Again, I'm just doing the chart because I want to show you what happens. So now we have the short-term yields here. They're usually lower than the long ones. That makes sense. The long ones are 4%. The low ones are 1%. This is obviously not correct yet. Now, what happens is the Fed has been raising rates. They raise the discount rate, which affects the Fed funds rate, which actually pushes up the short-term rates. So what happens is, let's clear that shit out. So what happens is, as they raise the rates, the lower rates go up. Now look, it's a flattening yield curve, right? So the Fed is raising rates and they're flattening the yield curve because rates move faster than prices, okay? Short-term rates move faster than prices. As we do it, they're raising, raising, raising. We're getting an inverted yield curve. So let me bring that down so we can see it. So the more they raise, the more aggressive, the more the short-term ones go up. Now, what happens is eventually these will start rising. Okay. They will. They'll come after, but they will until we have a much higher rate. Okay. So if we have a normal yield curve, let's make it small so we can really see it, right? So here's our normal yield curve. Just say this is it. Okay. Now, if I start raising rates, I'm the Fed, I raise rates, boom, I raise them up here. That's immediate. Then it's an inverted yield curve where the short term are higher. That means if you see an inverted yield curve, that means the Fed has been raising rates. And if you see a normal yield curve, it means Fed has been lowering rates. And again, they use a discount rate, which is a very short term rate. So all the short term rates move first. Then eventually, like a big old ship, these start rising. And then we're sitting in a higher invest. And we go back to normal eventually, but we're in a higher interest rate environment. And then when the Fed starts lowering rates, it'll steepen. That boom, 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 right? They steepen, steepen, steepen. And then eventually these will start dropping too, and it'll go to normal. Now, if they keep lowering it, boom, 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 it'll go like that. We're good. And then we head into a good economy again, and then they start raising, and then we go up and up and up again. And that's the cycles, and that will be an inverted yield curve. Hope that helps. That should be as much as you need to know for the SIE exam, the Series 7 exam, and I'm hoping that helps with everyone in general so you learn what an inverted yield curve is. Thank you very much. Please feel free to like this shit, share. Join me on YouTube's every Tuesday and Thursday. YouTube's. Well, guys, if you like this stuff, check me out at Capital Advantage Tutoring. Go check me out on YouTube. I do a live Q&A every Tuesday and Thursday night, free, 8:30 p.m. Eastern.